Hello everybody, Luke Gromen, FFTT. Hope everybody had a great weekend. Going to jump right into the discussion. I appreciate everybody's questions first off. From QR, what is the most important piece or pieces of data you are waiting to see to determine if your thesis is correct? A lot of smart people out there think we will have a fairly standard deflationary recession. I can't buy that, but it could be correct. Great question. First, I would say there's some things I'm looking for in terms of dogs that are barking, and then I'm also going to be looking for the proverbial dogs that don't bark. So what I mean by that is dogs that are barking. Federal and state tax receipts, I think, are going to be a big one. You started to see a collapse in June in New York, California. You saw U.S. tax receipts down big on a single month in May. They're going to get worse, just if nothing else, given the comps. So that's one area. Dogs that don't bark or aren't barking and should be. Energy prices falling. They're not. They should be. Yields. They should be collapsing, not just coming off the highs, but collapsing. They're really not. So those are the types of things I'm watching for. No one thing in aggregate, but it's more a mosaic, putting it together and trying to see things that are happening that should be, and then things that should be that aren't. From CM, Luke, do you think the U.S. can find demand outside of the Fed for Treasuries to allow us to keep running big deficits? I think that's where you and Snyder have a different view. Why would Powell pivot if demand for Treasuries remains high and the government can pay its bills? I think where Jeff and I vary is how long the U.S. can run this playbook. The U.S. can chase money out of equities effectively into Treasuries to support the Treasury market. They've done so in the first half of this year. But they can only do it for a little bit because the challenge is that the U.S. government also needs money in equities, going into equities, or needs rising equities, to fund consumer spending, which is 2/3 plus of GDP. And that then funds tax receipts. So if equities are going into treasuries, that gives you a temporary bid for the treasury market, but that means money is not going into equities, so equities are falling. If equities are falling, forget about falling. Alan Greenspan in 2015 said if equities just don't rise, let alone fall, this will happen. So it's really like a shark that needs to keep swimming to not die. If money is flowing into treasuries instead of equities, or out of equities into treasuries, then you're going to get consumer spending down, you're going to get GDP down, you're going to get tax receipts down. When tax receipts go down, you're going to have an increase in treasury issuance because most of what the government spends can't be cut. Entitlements, treasuries, defense, treasury spending, defense. And so your deficits are going to rise. So the amount of treasuries, or the amount of money you need going into equities, goes up. So now you need more money out of equities into treasuries to support the equity market. Equities down more, consumer spending down more, GDP down more, tax receipts down more, treasury issuance up more. Now you need more money out of equities into treasuries. This is not a guess. We've seen this empirically happen twice in the last 3 years. This was effectively what happened at the repo rate spike alongside some regulatory issues. The Fed jumped very quickly, started doing not QE to support that. And then, of course, we saw the sell-off in the Treasury market, really a crash in the Treasury market, alongside a crash in stocks in 2020. Again, you had a period of time, there was a flow into Treasuries, but then because of the importance of equity prices to U.S. GDP, U.S. consumer spending, and U.S. tax receipts, they can only run that playbook for so long. And I think that's a big difference where I think, it sounds like Jeff thinks that they can, and others, Jeff's not the only one, hey, let's just run the equity market into the treasury market. You can do that for a few months. You can't do that ad infinitum because the equity market is the economy on the margin. JT, how can you be so confident that the U.S. can only tighten so much because it needs to service its debt? Where is the line? Why has it not mattered prior to that? Does reserve currency status factor in, or a congressional ability to raise the debt ceiling? So, per Rogoff and Reinhart, Rogoff's former chief economist at the IMF, Reinhart, one of the foremost experts in the world on sovereign debt and sovereign debt crises, via Hirschman Capital, over the past 120 years, 98% of countries that got debt to GDP over 130% defaulted, typically via high or runaway inflation. Over the past 30 years, per the same group of people. 100% of countries that had debt to GDP over 110% and deficits of over 11% of GDP defaulted on their sovereign debt within 2 years, typically via, again, high inflation to inflate away the debt. The U.S. hit 130% in 2020, and it hit that magic level of 110 and 11% debt and deficits in 2021. And so basically, overwhelming consensus is it's different this time for the U.S. I don't think it's different this time. 120 years, 98% shots in this business, 100% shots in this business, they don't come around much. It's just a matter of managing your chips. Now, does reserve currency status matter? Absolutely. It matters in two ways. Number one, it means that if the U.S. decides to go into austerity, which we have just gone through a 4 to 5 month period of doing, where Treasury spending was down 30% year over year in the last 3 months on a trailing 3 month basis, then what you're going to get is a dollar super spike, and you're going to get the U.S. squeezing the world into austerity. That's what you're getting. You're getting Brent's milkshake, or the modified version of Brent's milkshake, where dollar up, everything else down. However, that is ultimately that's ultimately requires a belief that the U.S. will stand aside as every asset in the world basically goes to zero, including stocks, treasury bonds, U.S. housing market, all. They're not going to, policymakers are not going to stand aside and burn down the system they created, in my view. If you believe that, then there's no limit to the dollar, all that. I think ultimately policymakers are self-interested and legacy interested, and they are not going to stand aside and let the system they created burn down, which is what will happen if we do what we've done over the last 3-4 months for another, as little as 3 to 4 months, and certainly probably not more than 12 months. With that said, it also means that the U.S., the reserve currency status also means the U.S. has the leeway to print the money to fund its own deficits, which I think what they'll do. And when they do it, in my view, that will be extremely inflationary, not just for the U.S., but for the world. And that suggests owning assets, gold, Bitcoin, stocks, etc., more finite assets. So those are, like I said, 98 to 100% shots don't come around very often in this business. It's almost never different this time. And so it suggests it's much more about playing your chips and managing your chips well than getting the direction right. So from GB, which economy will collapse first? The Chinese with its banking and real estate imminent crisis, or the U.S. mega everything bubble economy? I think it's a trick question. They're both tied at the hip very closely and very tightly. And so if one goes, the other will go probably by that afternoon, maybe by the next day or the next week. But one goes, the other goes. And that's a good way to think about that, in my view, is, look, Lehman Brothers was $800 billion balance sheet. It defaulted, and within a week, it began putting the global financial system at risk. By way of comparison, China, as of a couple years ago, had a $37 trillion balance sheet and is responsible for a significant portion of the supplies on the shelves that you see in U.S. stores. So orders of magnitude bigger means orders of magnitude worse crisis, orders of magnitude faster. So from Sean, did the Fed pivot last week? My Fed decoder ring isn't working. In my opinion, maybe. I think a better way to think about it is that the Fed teed up the pivot for later this month at Jackson Hole. Reportedly, Powell is speaking there in 4 weeks. One thing I feel very strongly about is the data over the next 30 days are going to get meaningfully worse. I have pretty strong conviction in that. So I think going into Jackson Hole, you're going to have a softer or more dovish Powell from last week. 30 days of bad data, worsening data, and then him speaking. So I think it's going to be a really interesting month. From RD, would love to hear your thoughts on U.S. real estate over the next couple decades. I'm trying to grapple with the many variables at play: demographics, financial repression, remote work, internal migration, etc. I agree. There's lots of variables. The work from home dynamic, Amazon and what they're doing to light retail space, demographics, financial repression. I think I think for real estate, as far as how I'm thinking about it personally, there's I think two big factors, two of the biggest factors. I think number one, real rates have to be significantly negative over the next 5 to 10 years because of the U.S. fiscal position. So that's thing number one. You're going to get these periods of time like we've had over the last 3 to 6 months where the U.S. government and U.S. policymakers are going to pretend like they can actually tighten and send real rates positive, and they might even do so for a cup of coffee. But you're going to get what we're seeing now, which is the economy is coming unhinged very fast, and they're going to have to back off. So over the next 5 to 10 years, real rates likely need to be quite negative. So that's really good for real estate. All else equal. And then I think the other big thing is as always, it's location, right? So I think real estate that isn't unique in some way, lakefront, oceanfront, tied to commodities, so maybe farmland or hobby farm when you're thinking about a personal investment. There's a lot of other factors to consider. Baby boomers own a lot of real estate. Their kids don't. When the baby boomers die, how does that real estate transfer? Are there sales? Is it there's a lot. So I think sort of these two big factors, real rates very likely have to be significantly negative, and then looking for unique aspects, making it finite, I think are ways I've thought about it personally. From MB, much talk of U.S. versus Japan. We've now seen the Bank of Japan do explicit yield curve control and price action in yen crosses, Nikkei, JGB, etc. If when Fed goes to yield curve control, how will major U.S. indices react in similar and different ways? I think it's a when the U.S. goes to yield curve control, and I think it'll be much more, the outcomes will be much more Argentinian, unfortunately, effectively. Because again, Japan runs a current account surplus, or did until their energy bill went to the moon over the last several months. U.S. runs a current account deficit. Japan has a net international investment position called positive 65% of GDP. In plain English, Japan can sell its dollar assets down to zero to finance its deficits when it goes into a deficit situation, or its fiscal deficits if it wants to. The U.S. has no such option. Its net international investment position is negative 75% of GDP. There is no savings account for the U.S. The savings account is the Fed printing press, and they will use it, as we have seen. So I think it's going to be much more inflationary, much faster in the U.S. when the U.S. goes to yield curve control. And then it's going to feed on itself because, again, Japan finances its fiscal deficits internally. The U.S. still finances a significant portion of them internationally. So you will see the bond market globally put itself to the Fed much faster than the bond market. The JGB market has put itself to the Bank of Japan because as long as it's internally funded and there's deflation, there's still okay real rates for Japanese savers. That's not what's going on here in the U.S. with this situation. And then finally, from AG, please cover your take on gold for the remainder of the year and into 2023. Miners have been disappointing year to date. They had a great first quarter, and then it's been all bad news in the second and into the early third quarter. Gold, slightly disappointing, but not really. Gold has outperformed pretty much everything but the dollar and oil year to date, and especially given what has happened to nominal rates and real rates, I think gold's actually done pretty well. And I still really like gold for three reasons. Number one, Western governments will default on their sovereign debt with sustained real rates, positive real rates. They need sustained significant negative real rates. That's a great environment for gold. That has not changed at all. If anything, it's gotten more favorable in terms of the outlook for gold. Number two, gold tends to trade with oil over time. And peak cheap oil, peak cheap energy is playing out before our eyes. And so that's positive for gold. And then number three, again, another thing that I think is accelerating before our eyes, multi-currency settlement of energy, it's progressing. And it is likely to be accelerated by this year's events. You've seen comments from Zoltan Pozsar talking about this. You've seen comments from Pippa Malmgren talking about this. And what I mean specifically, the EU and Japan are going to have energy crises soon. One way out of that is to buy energy in their own currency and settle in gold. Not saying that's what's going to happen, but it could. And ultimately, things are going to come to a head because of these energy crises. And ultimately, using gold in any capacity to even partially settle energy surpluses or deficits, as I think we are moving toward, as the evidence suggests we're moving toward, requires a much higher gold price, a much higher physical gold price. So with that, I'm going to finish up for today. As always, thank you for joining me. If you're interested in more updates like this, check out FFTT-LLC.com for more information on our tree rings product. 10 most interesting things, quick synopsis of what we found interesting about it and how it either fits or refutes some other prior way we had been thinking. So everybody have a great rest of your week. Look forward to talking to you soon. Take care, everyone.